few weeks ago, the stock of AT&T was experiencing a phenomenal bull run. After years of being lost in the wilderness, the gigantic telco company seemed like it was finally turning itself around. And the stock's still up more than 30% for the year. At the beginning of September, the activists at Elliott Management announced that they'd taken a position in AT&T. They laid out a very compelling thesis to buy the stock. In response, the stock caught fire. It was cheap and a high yield, and the underlying company had a ton of room to improve now that you had some big-time activists holding management accountable. Then, on November 19th, the stock simply hit a wall. It sank from $39 to $37 over a couple of days, which is a substantial move for a roughly $280 billion company. And since then, AT&T shares have been pretty much stagnant, marking time. What happened? Craig Moffett, an incredibly influential media analyst at MoffettNathanson, downgraded the stock to a sell and gave it a $30 price target, down an astounding $9 from where it was trading. He laid out such a compelling bearish argument, even 3 weeks later, AT&T hasn't been able to get his mojo back. So is Moffett right? Is it time to dump the stock of AT&T after this humongous run? Or are you finally getting a chance to buy a piece of quality merchandise at a bit of a discount from where it was? I want to go over this powerful sell recommendation, but first you need to know the bull case that the downgrade derailed. And I want you to know it because I got to tell you, I think a lot of you own this stock are certainly thinking about buying it. See, when AT&T caught fire in September, it wasn't because people thought the company was in great shape. The stock had been a pariah on Wall Street for ages. No one had any faith in management. The company seemed to bumble from mistake to mistake. 2015, they spent $67 billion buying DirecTV, which has been an awful business. Then last year, AT&T doubled down on television, spending $109 billion to acquire Time Warner. Even though it's tough to explain how a phone company and a media conglomerate will necessarily benefit from being under the same roof. In fact, when Elliott Management announced that they'd taken a stake in AT&T, they released a blistering critique of the company's failed strategy. According to Elliott, the business had gotten too big and too complicated for its own good. But they also had a plan. And it was a plan that they believe can make AT&T into a $60 stock. And wow, do I ever like the plan. How are they going to get there? Elliott argued that AT&T needs to become more focused. They should sell off non-core assets, improve operational efficiency, pay down debt, maybe even bring in new leadership. In addition to dumping businesses like DirecTV, they want AT&T to bring in outside consultants to help bolster its historically, let's say, not so hot execution. If they can do all of that while protecting the dividend, which I know is key to you if you own it, currently yields 5.3%, the bulls at Elliott believe the stock can go much higher. Now, in late October, AT&T reported its third quarter results. It also gave us some long-term forecasts. These numbers look a lot like Elliott's estimates. By 2022, management's saying they can earn between $4.50 to $4.80 per share. Modest dividend growth, company paying down all of its acquisition debt from the Time Warner deal. In response, Elliott made it clear that management's working, and I quote, closely and collaboratively, end quote, with them to unlock value, which is exactly what the bulls want to hear. And it's why the stock rallied for the next few weeks. Key here is that the bull thesis mostly depends on Elliott. It's less of a bet on AT&T, more of a bet that one of the best-run activist firms on earth, one that I had come to respect from looking at the rigorous work, can force this pitiful, helpless giant to turn itself around. Oh, but wait a second. How was Craig Moffett able to derail this story? When he downgraded the stock to a sell roughly 3 weeks into November, sell, he made a very compelling argument. Basically, Moffett thinks AT&T's long-term forecasts are absurd. And when you drill down into the numbers, it's hard to see how they'll be able to hit those targets for 2022. This is a company with a bunch of declining businesses. Think wireline telephones, cable TV. The only potential bright spot is AT&T's currently stagnant wireless business. And that division will help to accelerate dramatically if it's going to offset accelerate dramatically if it's going to offset the weakness in everything else. Given this bleak outlook, Moffett argues that AT&T's stock was simply too expensive. It's down less than $1.50 since then, but the momentum is gone. So does this bear have a point? I hate to waffle like this, but yes and no. I think he's right that the new long-term forecasts need to be approached with skepticism, but that doesn't mean the stock's a sell. These are very ambitious targets. That's the whole point. After a decade of complacency, somebody's finally holding AT&T's feet to the fire. Plus, I get the sense that these targets may be more doable than Moffett would have you believe. For example, that acceleration in wireless, well, with the transition to 5G, AT&T expects a major pickup in iPhone sales in 2020 and 2021. I agree with that. If we're on the verge of an upgrade cycle, then those forecasts seem a lot more achievable. On top of that, last week, AT&T's chief financial officer, John Steffen, spoke at the Wells Fargo Technology, Media, and Telecom Summit. He went into more detail about how the company would hit those targets, making some, I thought, pretty encouraging comments about the Warner Media business, which is seeing real strength thanks to HBO and Cinemax. Stevens also pointed out that AT&T's seen real stabilization in business wirelines and in total business solutions. In other words, the legacy divisions Moffett's so worried about might be doing better than you think. At the same time, if AT&T can step up its wireless growth, most of those costs are fixed, so it will give the earnings a major boost. Better yet, AT&T's done a terrific job of paying down debt from the Time Warner deal to the point where Steffens talked about how they're going to get more aggressive about raising the dividend and buying back stock going forward. And that's exactly what the bulls want to hear, although I would prefer them to raise the dividend. The buying back stock is enough already. Put it all together, I think Moffett's missing the forest for the trees with this sell recommendation. Even if he's right that it's borderline impossible for AT&T to hit its forecast for 2022, I don't think any of the bulls are really banking on those numbers. This is a forced turnaround play, meaning Elliott's management is forcing AT&T to get its act together. If the company can't make real progress toward its long-term guidance, I have to believe Elliott will come down on them like a ton of bricks and bring in a new team. The thing is, AT&T's got some iconic brands, but it's been over a decade since management was really motivated to create value. If you buy the stock here, you're betting that the company has a lot of room to improve with more focused leadership. Given that AT&T is currently selling for less than 11 times next year's earnings, estimates it's got a 5.3% yield, I think it's a bet worth making. Bottom line, if AT&T were trading in the 40s or even the mid-50s, where Elliott believes it can go if the company hits its long-term targets, then the stock would be a sell here. But at $38, AT&T's already trading like those estimates are unlikely. And hey, if management can deliver, I see this stock going much higher. John in Florida. John.
Hi, Jim. Long-time listener, first-time caller.
Okay, thank you for calling.
And I just wanted to say thank you for helping me make money on Disney. I bought a bunch back in the 40s years ago, and I just sold it just because I thought it was time to take the profits.
Okay.
And I wanted to know, should I keep buying or holding on to the rest that I have or sell it?
Well, John, first of all, thank you for the kind words. I want you to hold it. I'm doing a conference call on Wednesday for ActionAlertsPlus.com members, and I know I like to play with an open hand. I'm going to say you hold on to it because I do think that next year's going to be another big year, and I like Disney Plus. I think that Bob Iger's doing a very good job. Bill in Arizona. Bill.
Hey, booyah, Jim. Bill from Arizona. Thank you for all you do to help the everyday investor.
You're welcome.
My stock is Ciena, ticker symbol CIEN. It reports Thursday before the bell. He had a good third quarter beat back in September, but it's dropped like 20% since then. Was wondering if Ciena's a buy now at this price.
That is a very, this stock has been so inconsistent. It's either great or bad, and that is just too high risk a name for me. If you want to know, if you want telco equipment that's at a discount, you want to buy Marvell, MRVL, which had a fine quarter but is doing a reorganization to switch more to 5G, and people don't see it. They're willing to buy Qorvo and they're willing to buy Skyworks, and she's willing to buy Marvell. That's the better bet. The bulls and the bears both raise good points when it comes to AT&T, but I believe the stock's only going higher if management delivers. I do think they will, though. Much more Mad Money ahead. More than 14,000 of the world's most advanced data centers trust Nutanix. Should you trust an investment in the company? I'm talking with the CEO. Then it's no home sweet home when it comes to at home. I'm eyeing the company for its tough quarter. You know we've had them on. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.